A company can report a profit every single year and still go broke. The statement that sees it coming is the one nobody reads. That is not a hypothetical. It has a famous victim, and you will meet him in a minute. First, the one idea this whole episode stands on. Profit is built on a polite fiction called accrual accounting. Book the sale when the invoice goes out, not when the customer pays. Spread the cost of a factory over 30 years. Each rule is reasonable on its own. Stack enough of them together, and the bottom line becomes something a management team can shape. Cash is different. Cash has no opinions. Either the money arrived this year, or it did not. This is Read the Numbers, the series that teaches you to read a company the way a professional does, one statement at a time. You have read the income statement. You have read the balance sheet. Today, the third and final one, the cash flow statement, where the lies show up. The company was W.T. Grant. Over 1,000 department stores, a fixture of American main streets for 70 years. Through the early 1970s, its income statement kept reporting profits. Then, in 1975, it collapsed. At the time, the biggest retail bankruptcy in American history. Here is the part that matters for you. Researchers later went back through the books and found the cash actually generated by running those stores had been negative for most of a decade. The profits were an accounting story. The cash was the truth. And back then, no company was required to show you the cash. Wall Street boiled that lesson down to 6 words, and they have survived a century for a reason. Profit is an opinion. Cash is a fact. Open any cash flow statement and you will find the year's money sorted into 3 piles. Operating. Cash the business generated by actually doing its job. Selling coffee, shipping phones, writing software. Investing. Cash spent on the future. Factories, equipment, acquisitions. Financing. Cash raised from lenders and shareholders, or handed back to them. Earn, build, borrow. Every dollar that moves through the company lands in one of those 3 piles, and the pattern across them tells you what kind of company you are actually holding. Now watch a healthy one. Apple, in its most recent full year. The operating pile. Enormous. Comfortably larger than the profit the income statement reported. That gap is what honesty looks like, because it means real money arrived even faster than the accountants recognized it. The investing pile. Small next to what it earns. Apple's spending on equipment is a fraction of the cash its products throw off. And the financing pile. Heavily negative. Not because Apple is borrowing, the opposite. It is handing cash back to its owners, year after year, on a scale no company in history has matched. Earn a fortune, spend a little, return the rest. That is the signature of a machine that makes more money than it can use. Here is what the statement catches. Lie 1. Profits rising while operating cash falls. That gap usually means customers are not actually paying. Sales pushed into the books to make the quarter. Lie 2. Everyday costs dressed up as investment. One telecom giant moved billions of ordinary running costs into the investing pile and manufactured years of fake profit. And the cash flow statement is where the trick left fingerprints. Lie 3. A company that lives out of its financing pile. Operations bleeding, the hole quietly refilled with borrowed money. Growth by transfusion. All 3 fooled the income statement for years. None of them can fool cash for long. One more tool and you are dangerous. Take the operating pile and subtract what the company must spend on equipment just to keep going. What is left is called free cash flow, the closest thing in accounting to the truth. Money the owners could take out without harming the machine. One modern trap deserves respect. Many companies now pay their people partly in shares, and the statement politely adds that cost back, as if paying staff and ownership were free. It is not. The bill arrives later as your slice of the company quietly shrinks. Subtract it yourself. So here is your 3-minute routine for any company on Earth. First, put operating cash next to reported profit. Over several years, they should travel together, and cash should usually lead. Second, check that free cash flow exists at all, because a business that never converts profit into money is a story, not yet a company. Third, look at who is funding whom. When operations fund the building and the owners collect the leftovers, you are holding a machine. When financing funds the operations, you are holding a fundraise. The statement is 1 page. The habit takes 3 minutes, and it would have saved every single person who owned W.T. Grant. That's Read the Numbers. You can now read all 3 statements, which already puts you ahead of most people who own shares. Next episode, we join them together, the handful of ratios that turn 3 pages of accounts into 1 verdict on a business. Follow so you don't miss it. Full library at agenticsovereigncapital.com. Education, not investment advice.